here's the thing. If you look at, coming into earnings season, where people's expectations were for CapEx spending this calendar year, it was up about 25 to 30%. After earnings season, that number is closer to 60%.
If you're holding Nvidia right now, there is something you need to hear before the end of February, because the data building behind this stock is unlike anything this market has seen in years, and almost nobody is talking about what it actually means for you. The warning isn't what you think it is. It's not about the trade war. It's not about DeepSeek. It's not about macroeconomic headwinds or rising interest rates. The warning is something much more specific, and much more important for anyone sitting in this stock right now. But to understand it, you first need to see the numbers that have been quietly building in the background. Because here's what happened during the most recent earnings season that most people glossed right over. Going into earnings season, the expectation for capital expenditure spending, meaning the amount of money the biggest tech companies plan to spend on artificial intelligence infrastructure, that number was already elevated. Analysts were expecting growth of around 25 to 30% for the calendar year. That was considered aggressive. That was considered a lot. Then, earnings season actually happened, and that number didn't stay at 25 to 30%. It nearly doubled. By the time all the major tech companies had reported, the revised expectation for capital expenditure growth had jumped to 60%. Think about what that means for a second. These companies, the biggest, most well-resourced organizations in the world, looked at the artificial intelligence race they're in, looked at the competitive pressure they're under, and collectively decided to spend twice as much as people thought they would. That's not confidence. That's something closer to urgency. But here's where this gets interesting. Because when you trace where all of that money is actually going, when you follow the dollars from the balance sheets of Microsoft, Amazon, Google, and Meta, the path narrows very quickly.
There's only two guys you can spend this with, really. That's Broadcom and that's Nvidia. Both of those stocks are down year to date, even though their foundry, which is TSMC, is up 20.
There are essentially only two companies capable of absorbing that kind of chip and spending at scale. Nvidia and Broadcom. Those are the two names you keep arriving at no matter how you run the math. And yet here's the part that should make you stop and think. Both of those stocks are down year to date. Meanwhile, their foundry partner, Taiwan Semiconductor, the company that actually manufactures the chips, is up 20% this year. Something doesn't line up. The factory is being rewarded, the chip designers are being punished. That kind of disconnect doesn't last forever. At some point the market has to reconcile it. And for investors paying attention right now, that gap represents something real. And it's not just analysts making this case. The person with the most direct view into Nvidia's demand pipeline is Jensen Huang himself, the company's chief executive officer. He's been unusually direct about what he's seeing, not cautiously optimistic, not measured, direct.
Demand is sky high, and there's a fundamental reason for that. We're in the once-in-a-generation infrastructure build-out. This is the largest infrastructure build-out in human history, and there's a fundamental reason for that.
The largest infrastructure build-out in human history, that's the frame he's using. Not the largest in a decade, not a generational opportunity, the largest ever. And he's not saying it to hype a product launch. He's saying it to explain why demand at Nvidia isn't just elevated, it's structural. It's not going away because a competitor releases a cheaper model. It's not going away because one quarter disappoints. The need for this infrastructure is baked into what artificial intelligence actually requires to function at scale. But what Jensen Huang said next is the part that truly caught people off guard.
In fact, GPUs that we sold 6 years ago, the prices are going up. It's not like it's antique. I mean, it's incredible. It's like a fine wine. The demand is so high that GPUs I sold 6 years ago are going up in price.
Chips that were sold 6 years ago, not the newest, most advanced hardware, but older generation graphics processing units, are going up in price. In almost every technology market that has ever existed, older products get cheaper over time. That's how it works. Demand shifts to newer models, older inventory gets discounted, prices fall. That's the normal cycle. What Jensen Huang is describing is the opposite. It tells you that the demand for artificial intelligence compute is so intense, so immediate, that companies are buying capacity wherever they can find it, including hardware that was considered outdated. Now let's zoom out to the full picture because the scale of what's coming is almost difficult to process.
Bank of America calculated the CapEx spending for Oracle, Microsoft, Meta, Amazon, and Google from 2024 to 2030.
Bank of America ran the numbers. They took the 5 largest artificial intelligence spenders, Oracle, Microsoft, Meta, Amazon, and Google, and calculated their combined capital expenditure from 2024 through 2030. Adjusted for inflation, the total came to roughly $2 trillion. To put that in context, That's more than the entire budget of the United States highway system. More than the total spent by NASA across its entire history. $2 trillion flowing into artificial intelligence infrastructure over the next several years. And a significant portion of that spend has Nvidia's name. So here's the question you should be sitting with right now, and this is the one I promised you at the start. If the spending is doubling, if the demand is so strong that 6-year-old chips are appreciating in value, if the $2 trillion infrastructure wave is only just beginning, if Nvidia is by almost every financial metric the cheapest stock in the Magnificent Seven, cheaper than Apple, cheaper than Microsoft, cheaper than Meta on a price-to-sales basis, then why can't the stock break above $200? That's the warning. Not that Nvidia is broken. The warning is that the market has built a wall of doubt right at the moment when the fundamentals are about to be confirmed or completely shattered, and that wall gets tested on February 25th.
We're looking for 65% revenue and 70% earnings growth, but the stock can't get above 200. And so if you look at all of the big Mag 7, Nvidia is by far the cheapest.
The cheapest, but you need to know more.
But there is such skepticism because it can't get over 200.
65% revenue growth expected, 70% earnings growth expected, and still, the stock sits below $200 with a ceiling the bulls haven't been able to push through. The skepticism is real. Some investors genuinely believe this is already priced in, that the story is known, the upside is baked, and the only direction from here is disappointment. That argument isn't crazy. Markets are forward-looking. If everyone already knows Nvidia is dominant, then being dominant might not be enough to move the stock. But here's what that argument gets wrong. Think about what happened with Amazon Web Services. Back in 2006, Jeff Bezos decided to move forward with what would become one of the most valuable businesses ever built. Wall Street doubted him. A Business Week article at the time framed it as a risky bet, a distraction from Amazon's core business. The market was wrong, and the people who sat through that doubt were rewarded in a way that almost no investment in history has matched. The parallel isn't perfect. Nothing ever is. But the pattern, massive capital commitment, genuine market skepticism, and an outcome that makes the doubters look foolish in hindsight, that pattern has repeated itself before. The question is whether you're willing to sit in the uncertainty long enough to find out if it's repeating again. Here's what you need to watch before the end of February. First, revenue guidance, not just the number they report, the number they project forward. If Nvidia raises its outlook and signals that the hyperscalers are not slowing down their orders, that's the catalyst that breaks the ceiling. Second, listen for any language around supply constraints. The company has been capacity limited for over a year. If that's beginning to ease, revenue growth could accelerate faster than the models currently predict. And third, watch the reaction in the first 30 minutes after the report drops. Stocks that are being held back by doubt often don't need perfect numbers. They just need numbers good enough to prove the skeptics wrong. That's the level Nvidia is being held to right now. The warning isn't that this investment is dangerous. The warning is that the end of February is a moment that matters, and walking into it without understanding what's actually at stake is the only real risk here.